Welcome to our market and economic update. If you're feeling like this year's market has been wilder than a cat on catnip, you're not alone. In this video, we'll dive into the roller coaster ride that's taking the market to new all-time highs and check in on the state of the U.S. consumer. Despite the ups and downs, it's not all doom and gloom. In fact, while it might feel like a rough year for returns, the Dow just strutted past 40,000 for the first time ever, and most indices are chilling near new record levels. So what's the deal? It all comes down to markets' mood swings driven by economic data and the Federal Reserve expectations. Over the next few minutes, we'll explore the financial health of the U.S. consumers, arguably the most important piece of the economic puzzle. Let's get started. Let's take a look at this chart that shows household net worth over the past 3 decades. It's like watching a plant grow, slow and steady. But instead of leaves, we're talking about financial assets like stocks, bonds, and homes sprouting up. You'll notice that net worth tends to climb during bull markets and when home prices are on the rise. It's like the financial equivalent of getting a promotion and finding a $20 bill in your pocket on the same day. This growth in net worth has been a major driver of wealth throughout history. Now here's the cool part. The stock market has a big impact on our financial health. When it's up, our balance sheets look pretty healthy, but there's a catch. This goes both ways. Thanks to something economics call the wealth effect. Fancy term, right? It basically means that when we feel richer, we spend more. So when consumers are feeling good, whether it's from higher wages, a booming investment portfolio, skyrocketing home prices, they tend to splurge a little more on goods and services. This extra spending then boosts corporate revenues, which can help stock prices climb even higher. It's like a financial feel-good feedback loop. Now, let's keep that wealth effect rolling. Let's dive into another important piece of the financial puzzle. Even though overall net worth has been on the rise, consumer debt has also been climbing, like that laundry pile you keep meaning to tackle. This means that for many households, monthly payments are starting to feel like a full-on gym workout, especially with interest rates flexing their muscles. Here are some eye-popping numbers. Total credit card debt in the U.S. has jumped to a whopping $1.1 trillion. And auto loan debt is now cruising at $1.6 trillion. Yikes. But wait, there's more. Delinquency rates are speeding up faster than your favorite sports car. According to the Federal Reserve Bank of New York's latest household debt and credit report, credit card delinquencies have risen to almost 9% of balances compared to the 10-year average of around 6%. Not exactly the type of trend we want to see. And if that wasn't enough, consumers are saving less today than they did during the pandemic years when saving rates hit the roof. So while households are generally doing well, many are still grappling with heavy debt loads and those pesky higher monthly payments. Let's wrap things up with a look at this chart showing consumer sentiment. These numbers can swing like a yo-yo because consumers are influenced by so many different factors. Lately, consumer sentiment has been cheerful as a Monday morning, thanks to higher inflation and an uncertain economy. But it's not all doom and gloom. Unemployment is still at record lows, and wage gains are looking pretty solid. If inflation keeps cooling down as it did in the last Consumer Price Index report, CPI, we might see those sentiment numbers start to brighten up. So what does this mean for long-term investors? Well, consumer spending is a major driver of economic growth in the U.S. The resilience of the consumers is a big reason why markets have rebounded and hit new all-time highs. Remember, it's crucial to focus on these longer-term trends rather than getting caught up in the daily market drama. We hope you found these insights as enlightening as a well-timed meme. If you want to dive deeper into any of these topics, don't hesitate to reach out.